My name is Zach, and this is Dividend Data. Over the past few years, I've shared my financial journey here on YouTube. A big part of that is a long-term dividend growth stock portfolio, which I update every month on the channel. And today is a continuation of that series. But what's the why behind building this portfolio? What's the goal? The goal is financial freedom. Now, I suppose we should define that. Financial freedom, to me, is having your money make money for you. It's where you don't have to worry about where you find your next job or being fired because you have independent financial security beyond that. This level of financial independence could allow you to quit your 9-to-5 or at least change your relationship with those kind of jobs. You no longer have to be dependent on anything. Now, there are many paths where people can reach financial freedom. You could be a business owner, you could have side hustles. I'm lucky in that that's the path I took out of college, and it's been pretty rewarding, but it does take a lot of work, and not everyone is up for that. You might end up working more than you did at your 9-to-5. It's a very different lifestyle, and your work can start to become your life in a lot of ways. And there's nothing wrong with having a normal salary job. However, it is possible that you can use the income of your 9-to-5 to fund your eventual freedom from that system. That could be retirement, early retirement, or allowing you to find a career that maybe doesn't pay as well, but you find more rewarding in some ways. And I believe that stock market investing, specifically with a focus on dividends and living off of the cash flow, can be a great solution for most people. With dividend investing, you can build your escape hatch, or a level of financial security so that you and future generations of you will be secure. That's a future where you can just live off the cash flows your money produces, and you don't ever have to worry in that regard. To responsibly take this dividend investing approach, it's not a get-rich-quick scheme. You need to build up a sum of assets that pay you cash flows. That can be through individual stocks or ETFs and mutual funds, depending on your level of interest. So in today's video, I'm going to explain what dividend investing is from like a basic level to then intermediate. And finally, I'll update you on my portfolio, what I'm invested in, show the progress I've made, and where I think it will go long term. I'm also going to do the math so you can ballpark how much you need invested in order to actually reach that point where you could live off dividends. So yeah, I'm going to walk you through a week of me investing. I'm going to show how I analyze stocks and the different tools that I've built to help me do that. Full portfolio update. But first, let's roll the intro. Welcome to Intro to Investing 101. So first off, you know how I mentioned earlier that one of the ways to reach financial freedom is to own your own business. That way you're not actively trading time for money. Instead, you own assets which are paying cash flows, which is money. Well, what is a stock? When you buy a stock on the stock market, you are buying a partial ownership stake in a business. So even though it may be small if you're buying one share of something, you're becoming a business owner. Investing in stocks can be your first step into the ownership side of the economy. So this dividend investing approach largely is taking your actively earned income and turning it into buying assets, which would be passive income. When you buy a stock, you're hoping that the value of the asset will increase, and that results in the stock price going up. But stock prices are only one part of the way where you can get returns through the stock market. The other way, which a lot of times people don't even really think about, is dividends, which is the company paying a percentage of their profits to investors. And you can think about this on the smallest terms, not even a large public company like Microsoft or something like that. At the smallest level, say you had a business with you and your friend, and you both have 50% ownership. And at the end of the year, you have a amount of profits and you want to pay out some of it. So I just drew this very simple diagram. I could go way more complex, but we're going with basics here. All right, so you have a business. They have a product or service that they sell in the market, and that generates revenue. And this is the top line money you make before there's any costs, you pay your employees, etc. And then the money that is left over after all of the costs is the profit. And ideally, you want to make money when you go into business. This isn't the newfangled, venture capital backed startup. We lose money for 10 years plus. In the small business world and in the ideal of the big business world, you want to make money. You want to have profits. And those profits, they go into cash in the company. The board of each company, if it's a small company, that's you, like if you're the only owner. But in these large stock market companies, they have a board of directors. And at the end of every quarter or year, they decide whether or not they want to pay some of those profits to the shareholders, which are the owners, the people who buy the stock. And in the public market, these are called dividends. What this really is just a distribution of profits to shareholders. So let's use a very simple example of a stock that pays a dividend. We're going to call it stock A. This stock is trading at $100. So it's $100 for every share. And let's say that it's paying a dividend of $3. I don't have good handwriting. I'm a lefty. I work with computers. So this stock A pays an annual dividend of $3 per share. So for every one share you own over the course of a year, it will pay you $3. Now this is typically broken up into different frequencies. The dividend frequencies that are most common are quarterly. There's also monthly dividends, so that the dividends would be paid every month. A common stock for that is Realty Income, ticker symbol O. There's also semi-annual, so twice a year, and annual once a year. And occasionally, companies have really good quarters and they'll pay a special dividend. One example of this, Costco, they're known for their special dividends. They do one every few years. So this brings us to the next concept, which is dividend yield. So this is found by the annual dividend divided by the current stock price. So for stock A, it would be 3 divided by 100, which is 3%. This stock A is paying a 3% dividend yield. So what this means is for every $100 you invest in the company, you are getting $3 back every year in dividends. Now you might say, $3 doesn't seem like a lot, Zach. And you would be right, because it's not a lot right now. But what you're not factoring in is long-term growth and compounding. For example, I personally like to invest in high dividend growth stocks. So those are companies where every single year they increase the dividend by, say, 10% or so every year. So over time, the dividend keeps climbing up and up and up and up. And ideally, since I like to focus on total return as well, ideally I'm investing in companies where the stock price will follow that. And again, we're sticking to the basics here for this little presentation. So while we're still with stock A, let's figure out, how do you know if a stock dividend is sustainable or not? This comes down to how much the business is making, how much they're profiting every year. Let's say that for profits, a company is generating $6 per share. Okay. Now, if we want to get in the weeds here, there are different kinds of profit. You have net income, you have free cash flow. I like to point to free cash flow, but right now, let's just call it profit. All right. So this stock has $6 per share in profit every year. So you would ask, how sustainable is that dividend? And one of the key metrics to look at here is what we call the payout ratio. So this is what percentage of profits every year is being paid out as dividends. That is the payout ratio of a stock. We have the dividend per share divided by the profit per share. So in stock A's example, $3 divided by $6, and that comes out to 50%. So it's a 50% payout ratio. Now that is pretty sustainable. There are a lot of companies at different phases of growth. Some are younger and have a lower dividend payout ratio, but are growing them much higher because they're reinvesting a lot into their business. Other companies like Coke or Pepsi, they have a sustainable dividend payment, but it's around the 75% to 80% range because they pay most of their cash to shareholders. Now we can get into the weeds of which may be better in terms of total return if you're investing for 20 or 30 years, but this is what it looks like. Now, when you're investing for dividends, you can pick individual stocks, which is what I prefer to do because I like the idea of analyzing businesses and stock analysis. I'm really into it, but that's a personal preference. I'm into it. Other people, they might not want to focus on investing as much. It might not be a hobby of theirs. So they can invest into ETFs or mutual funds, which are funds, or you can think of it as baskets of stocks. So you could invest in the S&P 500, which is 500 of the best companies in the United States stock market. And the S&P 500 is really kind of the benchmark of which all investing is graded against. They also have ETFs and funds that are specifically focused on dividends. In the comments, you might see SCHD. That's a big popular one. It's from Schwab. Personally, I prefer to pick individual stocks, but it's not necessary in order to get the benefit of dividend investing and long-term compounding through the stock market. So now that you have the basic concepts understood, let's try and figure out how long it would actually take in order to live off of dividends and how much money you would need invested. These are all like very important practical questions. All right, so let's say your goal is you need $100,000. You need to make 6 figures. So let's figure this out. All right, so I drew this basic illustration to drive home the concept of if you were investing right now, how much money invested you would need in order to reach that $100,000 goal. On the dividend yield, we have that on the x-axis, and I have that going from 1% to 10%. This is a common range of dividend yields that you will find in stocks. Over 10%, there is a risk that the payout ratio may be bad, which is why the stock is being valued not good. And 1% is just like a respectable starting yield for most like high growth stocks. And then on the y-axis, I have the amount invested. So if you were only investing in 1% dividend yield stocks, you would need $10 million in order to get that $100,000 goal of annual dividend income. If you invest at 10% dividend yields, then you would only need $1 million to reach that $100,000 goal. And since this is both on kind of the range, I'll give you the middle estimate too. So actually, I should be redrawing this blue line. It actually looks more like this because a 5% dividend yield would actually, you only need 2.5 million. And how we figure this out in a more generalized way. Goal, 100,000. We'll call that G. G is going to be equal to your amount invested, we'll call that A, times your dividend yield, we'll call that Y. And remember, this is a percentage, so it's a decimal. It spells gay, that's funny. I don't know if I need to cut that out or not. I'm leaving it in because it made me laugh. That's the best clip of all time. So with the gay equation, we can use it. So let's say you want to live abroad and, do the nomad lifestyle, and you only need 50K to do it. So we'll say 50K goal. And let's say you want to be pretty sure. So you want to be pretty safe on the dividend. So you want a 3% yield. All right. So you have your 50,000 goal, which is equal to the amount times yield, which in this case would be 0.03. So you divide that. So divide this by 0.03 to solve the equation. And you end up with amount equaling, what is that, 1.6 million or so? 1.66? Throw a 7 on there. And if we do a 10% yield, then we'll do 50K divided by 0.10, and that will be equal to 500K. So if you remember the gay equation, you can figure out right now how much money you need invested at a certain yield in order to be able to hit your income goal. Now, in reality, most of us will not be lump summing in with the immediate goal of living off dividends tomorrow. Dollar cost averaging and investing slowly over time and using the power of compounding, reinvesting dividends and dividend growth and stock price appreciation to slowly climb over time, that over 10, 20, 30 years would be exponential. So I'm going to go use my projection tool that I built on dividenddata.com that will help model more realistically how long it would take to reach a goal if you're investing in this dollar cost averaging approach. And then I'm going to use some basic stock analysis tools so you can see what I look at when I research a stock. And then I'm going to be updating you on my personal portfolio, how it's going, how much I got paid this month in my dividends, and my plan to reach financial freedom through that in the future. So let's go to the computer. All right, so we're over here at the computer now, and I have loaded up dividenddata.com. And here you can see all my different accounts that I track. I have my stock research tool up here, and you can select a stock, like for example, Microsoft. You can view their stock price history, their earnings per share over time. You can view full financial statements, income statement, balance sheet, cash flow by quarterly or annual. You can view key financial metrics graphed out over time with calculated growth rates, and this is quarterly and annual. And then for dividend investors, we have this whole section on dividends, which you can see here. You can see the payout ratio based on both free cash flow and net income. And then you can see the dividend yield over time. You can create a watch list and track individual stocks or ETFs and mutual funds. And you can see how their price compares to the 50-day average and 200-day price average. And it's sorted so that you can find which ones are at a dip right now, which is useful for identifying which stocks may be at a discount. For example, I had Starbucks on my watch list, and that became something that I bought this week. And then we have the dividend snowball projection tool, which is what I'm going to be using right now. Before I get to the portfolio update, which I still will do, full portfolio update, I'll show my new buys and everything. So what is the dividend snowball? This is one of my more popular videos. And fundamentally what it is, it's showing the impact of reinvesting dividends, dividend increases, and stock price appreciation, all compounding over a long time period. So let's use that example of if you were starting right now and you were going to invest, let's say, $1,000 a month. And we'll use the metrics I used in stock A in the earlier presentation. So it's a $100 stock price, $3 per share annual dividend. And let's say that this dividend grows at 8%. And for the annual growth rate of stock price, what should we put here? Historically, the S&P 500 has been around 10%. So I guess we can put in 10%, but this will definitely, all of this will vary on a case-by-case basis. So let's say you invest $1,000 and you do that every month, not just one time. And this stock will say that it's quarterly. You can select between monthly, semi-annual, annual, and we'll say that we're going to reinvest the dividends. So this is a big part of the dividend snowball, reinvesting your dividends over time. This creates a snowball effect where you're reinvesting your earned dividends to acquire even more shares, which increases your future cash flow, which allows you to buy even more stock in the future, increasing your cash flow even more, and it creates a cycle where you're just building and building and building. So if we hit calculate, so with just $1,000 invested, in 5 years, you would have $83,000 of total value with $1,911 of total annual dividends earned. So we're still far away from that being able to retire off of your 9-to-5 with just $1,000 invested. So with this model, when would you actually reach that point? Well, by 30 years, you would have $48,748 in annual dividends earned, and that's at a value of $3.4 million. And at 35 years, you would have $77.8 thousand in annual dividends earned, and that would be at a value of $6.2 million. And thanks to the power of long-term compounding and reinvesting dividends, you actually didn't have to lump sum in that much money in order to get to these results. So over those 35 years, you would have invested $420,000, which is really reasonable if you think about it. So your dividend yield on cost, so what you actually invested to buy your stocks, it would be 18.53%. And here you can see graphs for how your total value changes over time, your total annual dividend income, and then your total earned dividends as well. And you can also importantly see the difference between reinvesting and not reinvesting dividends. So before you're at the point where you actually want to live off the dividends, ideally, you want to be reinvesting all of them so that you can add to the compounding and increase your future cash flows. So for example, by the end of 35 years, you would have $6.2 million by reinvesting dividends compared to $3.8 million if you didn't reinvest dividends. That is a gigantic gap. And that gap is the same with your dividend income. You have $77.8 thousand versus $48,000. All right, so let's say you wanted to get to a larger dividend income amount. Let's double what you're investing every month. Prioritize it more, $2,000 a month. And I mean, if you have a good paying job and you manage your costs well, especially if you're single, especially if you don't have a family yet, this is very doable. So in this scenario, by the end of 30 years, you would have $97,000 in annual dividends earned. That would be at a total value of just under $7 million. By 35 years, you would have $155,000 in annual dividends earned. That would be at a total value of $12.4 million. And you might notice how in these later years, the compounding gets crazy. The longer and longer you let your money keep working for you, the growth rate just keeps accelerating compared to what you initially invested. And again, you can see the gap between reinvesting and not reinvesting your dividends over the long term. So it may start slow, but the long-term compounding is massive here. And let's say you're starting late in life and you didn't actually start investing earlier, then you might just have to prioritize putting more money in every month. Also, a lot of you won't be starting from zero. You probably have a lump sum of investments that you've been saving up over time, ideally if you've been financially responsible, and you can use that as your base and your starting ground to seed your future compounding. So what does my portfolio look like right now? Well, first I would just like to let everyone know that you can get a 1-month free trial of dividenddata.com, which is the tool I built here. And all you have to do is enter the promo code TRIALMAY at checkout. I'll put it on the screen. And with that, you can track multiple portfolios and get access to the stock research and all the other features I discussed earlier. So your first month is free. And after that, if you like it, then I recommend that you switch to the annual plan because that will save you over $100 a year. So I have 3 accounts tracked here. I have a dividend growth portfolio, which I show every month on the channel. I have a non-dividend account, and I have a Roth IRA. In total, this is at $217,000 in value with $139,000 invested. So I have a 56.43% total return, which is a $78,400 gain. And here are all my stocks across those accounts. Now let's dive into the dividend portfolio though, since this is my monthly portfolio update. All right, so we have a total value of $163,000 with $112,800 invested. So that is a $50,000 gain, which is a 44.5% total return. All right, I'm switching to this view so it'll be easier to see for you guys. So my top stocks are Microsoft, which is a $40,000 position, and I have a 65% gain on it. And then I have the Altria Group, ticker symbol MO, which is a $23,000 value, and I have a 16.25% gain. And most of that gain is from the dividends earned. I have 62.27 shares that are derived from reinvesting dividend. And this is a similar story with ExxonMobil, since I also have a high yield on cost with that stock. That is a $19,000 value, and I have a 236% total return. 25.57 of those shares are from reinvesting dividends. And then we have my worst investment, Disney. We've talked about that before. And a position I'm looking to build here, Visa, that is valued at $14,280. I'm up 20%. And then I have Broadcom, which is one of my best investments of 2023, but I have not been buying lately. Then I got T. Rowe Price, Apple, Kroger, Enterprise Product Partners, PepsiCo, Chevron, Automatic Data Processing, and the newest addition, which I will discuss later, Starbucks. And this portfolio of individual stocks is highly concentrated among my top holdings, with about 25% in Microsoft, 14.2% in Altria, 11.7% in Exxon, 8% in Disney, 8% in Visa, 8% in Broadcom, 6% in T. Rowe Price, 5% in Apple, etc. And again, if we go back to what I said earlier, I have a small partial ownership stake in all of these different companies, and they pay me a small percentage of their profits. Over the following year, this portfolio is projected to pay me $4,655 in annual dividends. That's $1,163 a quarter, $387 every month, $12.75 every day, and 53 cents every hour. And here you can see the month-by-month calendar of payments and which stocks go in each month. So this coming May is a low month for me, but I just had my largest month of dividends ever. We'll get to that later. And then in June, I'm projected to get $490.12, and July is projected to be $614.80. And here you can see the diversification of these payments and which stocks are the highest part of that income. We can also see more granular statistics such as the frequency of each dividend, the dividend per share, the annual dividend, the total annual income, current yield, yield on cost, the snowball effect from reinvesting dividends. And the main point here for me is that Altria is my highest yield stock, and I have a 9.14% yield on cost. And from reinvesting dividends, that's up to a 10.36% yield on cost. And this is supposed to pay me $2,000.63 a year. You can see that will only keep growing because Altria has been growing its dividend around a 4% 5-year compound annual growth rate. And then ExxonMobil, which is my second largest dividend payer, pays $621 in annual income. I bought this at a great time. So my yield on cost was 9.29%. And from reinvesting dividends, that's up to 11%. However, the stock price has gone up a lot since then. So if you bought the stock right now, its current yield is only 3.27%. And here are all my upcoming dividend payments in the next few months. You got Enterprise Product Partners, Starbucks, Apple isn't in here, but they just announced today that it will be in the middle of May. And then here you can see how my dividend income has grown over time. In the lifetime of this account, I have earned $12,659 in dividends. Last year, I made $3,515, And so far in 2024, I've earned $1,631. I just had my largest month ever at $538.55. This was led by $499.71 from the Altria Group, ticker symbol MO. That's my high yielder that we were talking about earlier. In April, I also earned $12.68 from ADP and $26.16 from PepsiCo. But the overall trend here is long-term growth. Right now, my 3-month rolling average is $367.46. And the real growth of this income has changed over time as my investing philosophy has changed as well. So at the beginning of 2022, I kind of switched my focus to be much more on total return, and I cared a little less about starting dividend yield. So I was buying some lower yielding stocks that had much higher growth, both in stock price and earnings and free cash flow and dividends. So this was introducing lower yield stocks like Visa into my portfolio and Microsoft, which is the core position of this account. But those high yielding stocks can still make a big difference. For example, Altria, with that $500 dividend, that reinvested to 11.36 shares. I got over 11 shares of Altria from that. And that's that snowball at work. It increases my future income, allowing me to buy more shares next time, and that will just keep going. All right, so here are the stocks that I bought since my last portfolio update. I bought 5 shares of the Altria Group at a cost per share of $41.12, which is a $205 total cost. And then I bought 2 shares of Visa, one at $276.94 and one at $266.98. This was actually yesterday from filming this. And I opened a new position, which is somewhat rare for me. I bought Starbucks 15 shares at $74.58. That is a total cost of $1,118.70. If you invest in ETFs, I do think a dollar cost averaging approach is the best way to go for it because you can't really value an ETF that well. Then I do think it's okay to take, a few months off of consistent investing per se. So for example, mine can be streaky. Like, if in a couple months there's a really good deal, then I could drop 10K in that month and buy some. Like I've done that many times in the past. There will be months where I'll put 10, 20K into stocks and other months where I'll buy nothing. But over the long term, I am investing consistently and looking for things to buy. And since we were talking about dividend growth earlier, there were some big increases this month. Costco had a 13.7% dividend increase. Ameriprise Financial had a 9.6% increase. PepsiCo had a 7.1% increase. And Apple, just today as I'm recording this, announced a 4.2% increase and a $110 billion buyback program. And that is a big part of Apple's total return. They regularly buy back stock, and you can see this massive decrease in shares outstanding. Now, what that means is it's increasing the relative ownership stake of every share you own. So you actually own a higher percentage of the company by them buying back and taking shares off the market. But we should probably talk a little bit about this new Starbucks buy, since that was a big story in the news this week. So Starbucks, after announcing earnings this week, dropped 15% because they missed estimates and they lowered their forecast for fiscal 2024 growth from previously expecting 15 to 20% increase in earnings per share to now saying that might just be low single digits, which is a dramatic shift. So the stock rightfully fell significantly. And now it's at the lowest price since their 2022 stock price crash, and before that during the pandemic, which was a major correction in their stock. However, the company is still very profitable and in a dominant position in the coffee industry. They charge the highest prices and they have the most loyal customers with their rewards program, which is the biggest rewards app that's been going for like a decade now at this point. And the amount of money customers have in that app is actually equivalent to like a large bank at this point. I personally don't think Starbucks is going to decline in the future. And frankly, coffee is a good business to be in. People are addicted to the caffeine. They just go every single day. It's crazy. Over the last year, they made $3.6 billion in free cash flow. And after this recent stock price crash, they're valued at $84 billion. So they're trading at about 20 times earnings. That's really not that crazy of a valuation for something which is considered by many to be a premium brand and company. Their current dividend payment is $2.28 per share, which is a 3.04% dividend yield. And the other good part is that Starbucks is a dividend growth stock. Over the past 10 years, their dividend has grown at a 15.93% compound annual growth rate. Over the past 5 years, that's been lowered to 9.63%, and last year they only increased 7.55%. And based on this recent poor performance, that next dividend increase will likely be lower or similar to that range. I do think that it's possible for Starbucks to re-accelerate going into the future, but this next quarter to 2 quarters may be pretty ugly. But if you do think the company will do well long term and be much larger 10 years from now than it is today, then this might be a great buying opportunity to buy some Starbucks stock. Not financial advice, but I am sharing what I'm doing. And that dividend payout ratio is 66% based on free cash flow and 58% based on net income. And I might just add, with that new 3% dividend yield, that is the highest dividend yield you can buy Starbucks stock at in the past decade. So from a dividend yield perspective, this is the best buying opportunity in over a decade. So what are my concerns? Obviously, a slowdown to decline in some markets from the earnings report is not a good sign. But I do think that will be a short-term problem. Financially speaking, they own and operate most of their stores, which leads to large capital expenditures as they build out new ones and renovate old locations. So they paid $2.3 billion in capital expenditures last year, which is a rising cost pretty much over the past decade for them. So yeah, in 2023, they had $6 billion in cash from operations. But that, because of those capital expenditures, they only had $3.6 billion in free cash flow. Another concern is they have a large amount of debt, and they've used that debt to build a lot of stores, especially internationally. And Starbucks makes a lot of money. They have over $3 billion in cash on hand, so they're not like in a bad position by any means, but it is a concern. And this is something you don't see in a company like Visa. Now, the other part of that debt is they do have a very high return on capital employed. So in fiscal 2023, that was 29.21% was their return on capital invested. I also heard on their earnings call that some of their international markets where they're opening up these new stores, they're getting 42% cash on cash returns from investing in these stores. So with that knowledge, it does seem to be a no-brainer to potentially use debt to build some of these stores. It still introduces a level of risk, I would say. But yeah, I used the opportunity to buy my first Starbucks position, 15 shares. It's now the smallest stock in my portfolio, but I will likely add to it over time, especially if it keeps falling from this current range. So I'll probably put some like buys leveled out at like $73, $71, etc. All right, so thank you guys for watching episode 2 of this new format of video. I'm pretty excited about it. New episodes will release every Friday at 11 a.m. Eastern Standard Time, real time. And tomorrow, after you guys watch this, there will be the Berkshire Hathaway annual meeting, which is the first one since Charlie Munger passed away, and it's going to be Warren solo up there with the new guys. So that will be pretty exciting. I'll watch that. And I'm thinking that I'll record a little bonus video to release earlier before next week's episode, with a little bit of my reaction to it. Make sure to subscribe if you want to see future portfolio updates and stock market analysis. And if you want to try out dividenddata.com, use that promo code TRIALMAY, which will allow you to use a free month. So subscribe, leave a like. Thank you for watching.